bullish market. How do I offset that bullishness? How to offset that bullishness? Well, I could reduce size, but that's obviously going to take away a lot of my profits. I could buy calls, but they're going to be very expensive, Paul. I could do a spread, right? I could do some sort of bull spread. So what I could do is I could buy calls into that, and obviously I could take a massive risk and sell puts to take advantage of the volatility, yeah? I could sell puts, but obviously I'm taking huge risks if I was to do that. But obviously I could sell an out of the money call at the top edge of that bracket, couldn't I? I could come in and say, right, I'm going to buy an at the money call. So I could buy an at the money call in here, and I could sell an out of the money call up here just to reduce the cost. Because if I sell the call, I'm still getting some of that option volatility premium back into my account. So I can offset some of the cost of this, and it doesn't give me that double risk which selling a put would give me. So in this kind of location, I could go long calls here. I could go a long call at that position, yeah? And I could sell a call at this price up here. I could sell a call at the next strike up here and try and get some of that premium back. I could try and get some of that premium back simply by selling calls at these higher strikes. And that way the cost of my call option is offset, because obviously the volatility is still going to be I'm going to take some of that volatility off that trade. And so long as the price doesn't explode through this, and according to the skew, it's not going to explode through this, is it? So obviously in that case, my short calls aren't going to cause me any grief. And obviously if it goes through the short call, basically I don't make any money anyway, because I'm flat the market. You know, at that stage, long call to sell call, I'm basically trading the brackets. That's all I'm trading is a bracket in terms of that narrative. But the skew tells me to trade the bracket, not to trade an extension. So for example, if I was to buy a put here, if I bought a put here, the one thing I definitely wouldn't be doing is selling a put there, correct? Because this is telling me that this extension is going to take place here. So there's no way I would have bought a put option at the top of that bracket and then sold a put option here to do a put spread, because I think with the skew making a break to the downside here, I think that there's a very good chance that the price action will take this price straight through the slippy no bottom edge, right? So in that type of environment, you've got to be aware of what this is doing, because that's how we start seeing how slippy it is outside these brackets. You know, if the skew is inside the bracket, then of course the price is pretty flat outside the bracket. The probability is less, because remember, that's what this is. I mean, when you think about what delta is, it's a probability distribution, correct? If you think about what your delta strikes are, when you look at a strike, when you look at an option list and you go through this option chain here and you say, right, well, where's the 25 deltas, and you're way out here, it's a probability. You know, if you've got a probability, that it normally says, well, the probability is X at 25, isn't it? So you can start to work through that probability distribution and say, well, the probability distribution looks something akin to this. You know, that idea that at the monies, and then as you go further and further out the deltas, you can start to recognize, you know, when you reach the 25 deltas, your probability is so low. But obviously that's the idea. This has got no skew in it whatsoever. So obviously if I started to skew this, what would happen? So imagine the skew started to look a little bit more like this. Imagine that skew started to happen. Well, the probability is getting higher that you're going to start moving towards that there. And that's obviously a very bearish skew, isn't it? So your skew would have been originally, your skew would have probably have been very, very flat, very neutral. And obviously your skew going from very flat to very neutral is now getting hammered here as a sell skew, because that's opening up the idea that the probability of this taking place is now huge. So we can obviously start recognizing that increasing volatility is going to become very slippy. So the one thing I'm never going to do is sell a put option. Never going to sell a put option down here. That's madness. I would sell a call option in that type of situation, absolutely. So I'd sell a call option to gain some volatility back into my account. If I'm trying to buy a put option, I would be selling a call option against that. That's because obviously I've got the skew in my favor to do that. I've got a double exposure to the upside, but it's taking the option value off that volatility. It's giving me back some of that volatility premium.